Advanced Financial Accounting. In this presentation, we're going to work through a consolidation problem where we have a parent-subsidiary relationship. We're going to be putting together a consolidation worksheet for the two of them. We'll be dealing with both downstream and upstream transactions. In other words, sales of inventory from the parent to subsidiary and subsidiary to parent for both the current year and the prior year. We'll also have a situation where a sale took place in the prior year and that inventory still has not all been sold in the current year, which is a little bit different than prior problems we have looked at with regards to downstream and upstream sales. We're also going to be using the fully adjusted equity method, or in other words, the parent company will be using the fully adjusted equity method to account for the subsidiary interest. Get ready to account with Advanced Financial Accounting. Here is our data. We're going to read through the data first, and then as we go through the practice problem, we'll be pulling pieces of the data as we go. So it's going to be a long piece of data. We'll go through it all at once, and then we'll go back through the pieces as we work through the problem. So P purchased a percentage of S voting stock. P is going to be the parent. S is going to be the subsidiary. P purchased the common stock on January 1st, 2000X2. So purchase took place in 2000X2. The percentage of stock was 70%, so that's going to be the controlling interest being 70, meaning 30% will be the non-controlling interest. The cost, or what P purchased the 70% interest for, the 70% of the stock, was $114,800. The non-controlling interest is going to be $49,200, and that means that this is going to be the non-controlling interest at the point in time of purchase valuation, so that we'll use that to calculate our goodwill. And then the common stock and the retained earnings are going to be these two items. In other words, this is basically the book value. Another way to say this is the book value, meaning the equity section of S at the point in time of purchase, which we're going to need to calculate, say, goodwill. And then they consolidate as of 2000X3. So that means that the purchase took place in 2000X1 January. We're talking 2000X3 now. So that's going to be 2 years to the point of consolidation. So we had, let's just take a look at X2, January, and then X3. So the book value and fair value are the same, except for, in other words, at the point in time of purchase, if we were to take a look at S's assets and liabilities, all the book value for each account is the same as the fair value, except for equipment, which has a fair value of $22,000 higher. So we're going to have to increase it in the consolidation. And intangible assets, which have a fair value higher of the $47,000. These are both things that we're going to have to either depreciate or amortize. Therefore, we're going to need the useful life to do so of the 5 and 10 for the equipment and intangible assets, respectively. We've got 2 years that happened. Therefore, we're going to have to deal with the accumulated depreciation for 2 years and 1 year for the depreciation expense for the current year that we will be doing the consolidation for. Then we have the accumulated depreciation of S at the point of purchase was $50,000, and then the 12/31/2000 X2 S sold inventory to P. This is kind of the new things that we're going to be concentrating in on here. Remember that as we do this, there's basically 4 things that usually happen, right? You've got to consider prior year's information where there was an intercompany sale either between P to S, parent to subsidiary, or S to P. Either way could happen in the prior year. And then we've got the current year activity that typically happens. Usually, once again, P can sell to S, or S basically sells to P, has an inventory transfer item on either side there as well. Another thing that could happen, however, is that we could have a sale that happened in the prior year, and we usually assume that all the inventory was sold then in the current year, because we would assume that the inventory that was intercompany sales in the prior year got sold by the purchaser in the current year. So that may not always be the case, of course. And if that's not the case, that adds a little bit of a wrinkle into our situation as well. So this is 2000X2 prior year, where S sold inventory to P. That's going to be subsidiary to parent, so upstream sales price and cost here. And then P resold in 2000X3. So notice the sale took place at the end of the year. Therefore, of course, nothing was sold, even though the sale took place at the end of the year. And then even in the end of 2000X3, it wasn't all sold yet. So we still had the $29,000 was resold in 2000X3. So that's going to be the new kind of little twist we have here. And then 2000X3, S sold inventory to P. So in the current year, 2000 X3, S sold to P. That's going to be the subsidiary to the parent for the cost of the 54 and the sales price, the 90. And then P did not resell by year end. So all of this is still on P's books, still in basically ending inventory on P's books. And then we have the 2000 X3, P sold inventory to S. So now what the parent is selling to the subsidiary for the 32,000 and the 16,000, S did not resell by year end 8,000 of it. So they gave us the ending inventory number, the amount that was not resold rather than the amount that was resold, and we can figure out the amount on the other side then. Then the fully adjusted equity method is going to be used. All right, so there's our data. Now we're going to start breaking this information out by the downstream and upstream transactions. That's going to be kind of like the new thing that we will be dealing with, and we're going to put this into as much of a systematic format as we can to adjust our cancellation entries or our consolidation entries. So this is how we're going to basically set this up. We're going to think about the 2000 X3 downstream transactions first this time. So I'm going to cover this up for a little bit here. So we're going to pull this data then from the information. This information to the left was gotten from our data. So the data said that in 2000 X3, P sold inventory to S. P sold inventory to S. Sales price is going to be that 32. The cost of goods sold is going to be that 16. And that means the gross profit, 32 minus the 16, is 16,000. 16,000 divided by the 32 will give us the 50% gross profit percent. The cost of goods sold percent is also 16 over 32, or 100% minus 50%. As well. Then we're going to be considering the amount that was resold. Now, with the amount that was resold here, S did not sell 8,000. So that means you have to do a subtraction problem to figure out the amount that was resold. So let's pull out the trusty calculator here. I'm going to pull out the trusty calculator, and we're going to say that we had then the 32,000 minus the 8,000, and that's going to give us our 24. And then the cost of goods sold, then I'm going to take that 24 times the cost of goods sold percent, or 0.5, to get the 12,000. There's the 12,000. 24 minus the 12,000 will be the 12,000 here, or you could take that 24 times the 50% as well for the gross profit margin percent. Then we're going to have the amount that's still reflected in basically the ending inventory, the amount that had not yet been sold, where we're going to have the 32 minus the 24, or that 8,000, same 8,000 as is over here. Then we can take the 16 minus the 12 to get the 4,000, or we could take that 8,000 times the 50%. And then we're going to take the 8,000 minus the 4,000 to get to the 4,000, or we could take that 8,000 once again times the 50%. All right, then we're going to move down. We're going to do a similar type of process here. This time we're going to take a look at the one that's a little bit more unusual, and that is the one where we had the sale. It took place at the end of last year, and therefore none of it was sold yet. So the assumption being that none of it was still sold as of the end of last year, and then part of it was sold in the current year instead of all of it being sold in the current year. Usually, again, we would think that if there was a sale intercompany that took place last year, then all the inventory would usually, you would think, be sold by the company that it was sold to in the current year. In this case, that's not the case, right? We still have some on the books at the end of the current year. All right. So S sold inventory to P. That's going to be the subsidiary to the parent or upstream sale. 50,000. Cost of goods sold, 30,000. Difference, 20,000. That 20,000 divided by the 50,000 is 40%. And if we take then the 30,000 divided by 50,000, that's going to be the 60%. All right, then we're going to say, all right, same kind of process here. We're going to say then we had the amount that was resold. The amount resold, notice they gave us the amount resold now. They could have said the amount that had not yet been sold as of the end of 2000 X3, where we would do a subtraction problem as we did above. This time they told us that was resold, so we're just going to pick up that number and say, all right, 29,000 was resold. If I had 29,000 resale times the cost of goods sold percent, or 60%, there's the 14,700. So the 14,700 minus the 29,000 is the gross profit, the 11,600. If I divide that 11,600 by the 29,000, I get back to kind of our check figure of that 40%. Then the amount that's still in ending inventory at the end of the second year, the current year that we're working on, 2000x3, is going to be, we could take the 50,000 minus the 29,000 to get to the 21,000. We could take the 30,000 minus the 17,400 to get to the 12,006, or we could simply take that 21,000 times the 60%. Then we could take the 21,000 minus the 12,006 to get to the 8,004, or we could take the 21,000 times the 40% gross profit. Then we could check our number to see if the gross profit percent is still lining up by taking the 8,400 divided by the 21,000. That's going to give us our 40%. All right, let's do this process one more time because it's good times. So we're going to go to the next one here. We have the 2000x3 upstream transaction. We're picking this up from the data that we saw up top, this little piece of the data that said 2000x3 S sold inventory 2P. So S subsidiary sold then 2P. Cost or sales price 90,000, cost 54,000, difference 36,000. 36,000 divided by 90 is going to be that 40%. And then if we took the 54,000 divided by 90, we get the 60%. Then we're going to say the amount that was resold. How much of it was resold? Well, P did not resell, they said. Now they're telling us basically what was in ending inventory at the end of X3. So we got to do our good old subtraction problem then. 90,000 minus the 26,000. That's going to be the 64,000. 64,000 here. Then I'm going to take that 64, multiply it times the 0.6 or 60% to get the 38,400. Take that minus the 64,000. That's going to give us the 25,600. Then I can double check the gross profit percent by multiplying that times 0.4 or 40%. I'm sorry, that's not how you do it. You take the 25,600 divided by the 64,000 to get the 0.4. So that means the amount that's still left in ending inventory, the amount that's still there is going to be the 90,000 minus the 64,000 or the 26. Yes, that's the same 26 here, which we could have, done this first and then backed into this number if you want to do that. And then we got the 26,000 times the 0.6, 60% of it, 15,600. The 26,000 minus the 15,600 is the 10,004, or we can take the 26,000 times the 40%. Then if we wanted to double check our percentage down here, we could take the 10,400 divided by the 26,000, and we're still at the gross profit percent, the 40%. Okay, next step. Let's move the trusty calculator out of the way here. We're going to go on down. We're going to say now we want to take this information and we want to fill out basically our worksheet. Our standard type of worksheet is going to be taking the net income that would normally be our first kind of consolidation entry, and we're going to adjust it based on these items. And then we're going to do the same thing for the balance sheet side of things, taking basically the net assets. So let's start with our beginning numbers that we would normally be taking here. The beginning numbers we'd normally take is basically S's net income. So here's S, here's P and S's books that we're going to combine together. We're just going to add them up. And now we're going to consider the first journal entry. We're kind of working on the first journal entry and some data that we're going to use in our consolidation entry. So we're going to say here's the 31,000, which was revenue minus expenses. So revenue minus expenses is this 31,000 for S. And I'm saying, okay, well, normally we would start out and say that there's going to be the controlling interest of that 31,000 times 0.7. So there's the 21,700. That's going to be our starting point. And then we would take that same 31,000 times 0.3, which is the non-controlling interest of the 9,003. And then we're gonna make our adjustments to it based on the kind of information we did up top. Then we're gonna take basically the balance sheet side of things, the net assets, and do the same adjustments to them. And you can think of that as kind of like our debits or our balancing entry that we're gonna be doing. So we're gonna take the net assets then. So let's do that little calculation. Assets minus liabilities, the green and the orange here. 17600 plus 6000 plus 37000 plus 42000 plus 262000 minus 90,000 minus 37,000 minus 90,000 minus 1600, and that's going to be the 146. That's our starting point. We can also get to that, of course, with all the blue numbers, which is the equity section. So let's just do that because that'll be fun. 70,000 plus the 62,000 minus the 17,000 plus the 140,000. And then all of this stuff down below is the income. So I'm just going to add the income, which is all this. So I'm going to say plus the 31,000, and I should get to the same number, and I totally didn't. So let's do it one more time. 70,000 plus the 62,000 minus the 17,000 plus the 31,000. And there's the 146,000. Taking that times the controlling interest, 70%, 0.7, that gives us the 102.2. And if we took that 146,000 times 0.3, the non-controlling interest, there's our 43.8. These would be kind of like the starting points we would have for that first entry that we would make for the consolidation entry. And then we're going to adjust to it based on the work we did up top. All right, so let's scroll on down and see what that process will look like. So now we're going to kind of fill this thing in. Let's move the calculator. So here's our same worksheet. I'm just looking at the top half now, where we started with that 31, and then we had the breakout of the 9.3 and the 21.7. All right, I'm going to put my little thing here so we can reveal this one thing at a time. So this is going to be our starting point, and then these two items are basically going to be the reversals for transactions that happened in the prior year, either sales from P to S, parent to subsidiary, or S to P, that are still reflected in ending inventory, which typically we would normally think of have been sold, in the current year that we're going to be working on. So we're going to basically reverse these items out. So reverse the gross profit, and that's going to be our first item. So the first one, we don't have any for the reverse gross profit deferral down. Notice we got the down and the up basically for the prior year. That's going to be the first two. So down being sales happening from P to S, the up, sales happening from S to P. And this is going to be our kind of unusual one because we did have a 2000X2 upstream transaction that went from S to P in last year, and therefore would be in the ending inventory, and therefore the beginning inventory in the current year, 2000X3. However, we didn't sell all of it, right? So we're picking up actually the amount that was resold. That's the amount that we're going to be reversing. So again, the normal assumption is going to be, the amount, whatever was in beginning inventory last year would have then been sold in the current year, right? But in this case, not the case, right? This happened in last year, and the amount that we need to reverse is the amount that was resold in 2000X3, which is the 11.6. So we're picking up the 11.6, and then whenever we look at the up items, we're going to be breaking them out between the non-controlling interest and the controlling interest, as opposed to the down items, which we're just going to be pulling to P here. So then I'm going to pull out our trusty calculator. That means we're just going to take the 11.6 times the 0.7. That's going to be the 8,120. And then, of course, the 11.6 times the 0.3. That's going to be the 3,480. Okay, and then we're going to do like the current year stuff. So that's going to be the gross profit deferral down. So now you're thinking current year, 2000X3 in our example. So the down meaning is going from P to S. And so we're going to say, all right, that one's going to be 2000X3 downstream. And we're going to do what our normal process is to be picking up this bottom line number, the amount that's still reflected kind of like in the gross in ending inventory. So we're going to be picking that item up. So we'll put that here. This is going to be a subtraction. So I'm going to put it as a subtraction because this is a down transaction going from P to S. We're just going to allocate it to P. We're not going to allocate it at the 70-30 split. Then if I reveal the last part here, we have the gross profit deferral up. And so we're going to say this current year transaction, up transaction in the current year. So 2000X3 transaction going from S to P. So here we have that. And again, we're taking like the bottom line number, the amount that's still kind of reflected in the ending inventory items. So that's going to be the 10.4. It's going to be a negative. So we're going to pick up our negative number here. Then if we pull out the trusty calculator, we're going to be breaking that out by the 10,400 times 0.7. That's going to be the 7,280. Then we'll take that 10.4, roger out, times 0.3. That's going to be the 3,120. Then, of course, if we were to add these up, we're subtracting the bottom two, so it would look something like this. The total column would be 3,100 plus the 1,160 minus the 4,000 minus the 10.4. And that's going to give us the 28.2. And then, of course, P, I'll do one more column. 21700 plus 8120 minus 4000 minus 27280 is the 18540. Now, once we have this top half, the second half is going to be easier. So now I'm just doing the same thing. Here's the top half. Here's what we just did with minus the color. And now we're just going to fill in the bottom half. So you'll recall the bottom half, when we started, we had these numbers, meaning the net assets, the 146,000 that we broke out 70, 30. That's simply the net assets minus liabilities for S. That's going to be our starting point. And then we're just going to do the same thing to it, meaning the meat here, from here to here, all the way across, is the same as from here to here. So once we do this up top, we could simply just copy and paste these numbers, this information, straight on down. We're going to do a mirroring transaction, similar transaction on the bottom line numbers, starting except with a different starting point, because this is going to be kind of like the balance sheet adjustment. So now we got the 146, and then the adjustments down below. Again, the top line being kind of what we would do in our transaction before this kind of adjustment, and then our adjustment to that first transaction. So it'd just be like 146,000 plus the 11,600 minus the 4,000 minus the 10,400. I just like saying 10,400, so I wanted to calculate that. So there's the 143,200. All right, so there's our full worksheet. Then we're going to go on down, and we need to do our Goodwill calculation, which we haven't done. We've seen this in the past. This isn't like a new thing. So let's do our Goodwill calculation. So we're just going to say, all right, we're going to start off with the book value of S. Book value of S. If we take our data, this is a piece of the data that was given to us. They gave us this time in the data, this 70,000 and the 25. That's basically the equity section, which is the book value of S at the point of time of purchase, like 2 years ago, not the point that we're consolidating 2 years ago. Okay, and then we're going to have the deferral in our difference in the fair value of assets was the 69, because we said down here that the equipment and the intangible assets had a higher value of 22 and 47 at the point in time of the purchase. And then, I don't know why it keeps jumping back up there like that, but then the fair value is going to be that 164,000. The non-controlling interest is going to be the 49,200. That's going to be picked up from here. So that was given to us, the 49,200. Then if we take the 164 minus the 49,200, the subtotal would then be the 114,800, which is the amount that you would expect to be paid if there was no goodwill. And that is indeed the amount that was paid. And therefore, there's going to be no goodwill in our problem here that we will have to be dealing with. Okay, so now we're going to basically think about that fully adjusted equity method. So before we do the consolidation here, we want to think about, all right, how did we get to this number, the investment in S, and this number, the income from S? Can we reconstruct that using the fully adjusted equity method, meaning we're going to use like the equity method and then adjust for it for those like intercompany transfers or sales or inventory transfers. So then what we're going to do then is we're going to say, okay, let's do the normal equity method. Normal equity method would mean that we're going to take like S's net income down here, which is the 31,000, revenue minus expenses. And I would take P's portion of it. So we're trying to reconstruct what P did to get to this number and this number. And it should be reflecting the equity of, S. So we're going to say that's the 31,000 times 0.7. So there's the 21,000 increase in investment, increase in income, standard equity stuff. Then we're going to take the dividends that S paid. So these are the dividends S paid. And that how many of those went to P? P owns 70%. So we're going to take that 17,000 times 0.7, and they should have gotten 11,900. So debit the cash 11,900 and credit the 11,900. All right. Then we're going to do the not so kind of standard, but something we've seen in the past equity stuff, which is that we got to adjust for the fact that we have this difference in depreciable assets. Those difference in depreciable assets are going to affect the income statement with regards to amortization and depreciation. Let's think about depreciation first. The depreciable assets are going to be increased by 22,000, which means the depreciation is going to increase. We're going to say by a straight line 10-year useful life. So I'm going to take the 22,000 divided by 10, and then I'm going to take that times 0.7, our percent. That's going to be the 1,540. That means the income that we're pointing on the books for S, reflected by P, is going to be decreased. So by the 1,540, and then the investment asset side is going to be decreased. Let's do the same thing now. So this is what we've done thus far up top. This is the new one we're working on for the equity method, to reconstruct the equity method. Similar thing for the amortizations. Just basically now it's an intangible. Same thing though. We got 47,000 higher. We're going to have to amortize that over 5 years. So we're just going to say 9,004 times our portion, 70% in the current year. Then we're going to have the income is going to go down by another 6,580 that we're going to be reflecting from S's income in our equity account here. And then the investment account's going to go down by that same amount. All right, so then if we scroll down, this is what we have thus far. This is what we've done thus far. Here's the new thing we're doing, and this is kind of like the new thing in general, and the new thing in total that we've had here. And that's going to, so here's our table. So here's our table to the right that we put together with the net income and these adjustments. We're going to reflect this in our fully adjusted equity method now. So this is what we've done to kind of construct the equity method for P. So we're going to take the investment in S. It's going to be debited by that 8,180. Notice I'm just taking P's column basically here, the amount that was allocated to P. And then we're going to be crediting the 8,180 for the income from S for that same amount. Then we're going to have the income from S debited now for this. Notice it's like the current year. The current year down of the 4,000. So we're going to be debiting that, and then we're going to credit the investment in S from the same amount. And then we're going to have the income from S is going to be debited from the gross profit deferral up. Again, the current year thing here, right? And then we're going to be crediting the investment in S for that 7,280. So that's going to reflect what we've done, what we built in our table. So if we put all that together then, let's put all that together. Now we have the fully adjusted equity method. Here's all those journal entries we put together in an attempt to see if we can reconstruct in the current year this account and this account that are on P's books that reflect the equity of S. So we should be able to reconstruct this one because this is in the current year. So here's that 10,420. If we take all the yellow numbers, this plus this plus this plus this plus that plus this, then we get the 10,420. So that looks good. So if in the process of our consolidation entries, we have a problem, because this should be a 0 at the end of the day, we can use this to help us reconstruct it. This number represents all the green numbers: investment, 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 investment. Does not tie out to what is here, because this is as of a permanent account that has been being constructed since the point in time that the purchase took place, which in our case was 2 years ago. But at least we can feel somewhat confident that we're doing it correctly, given the fact that this ties out, and that can help us if we have problems with our consolidation. Now let's finally do our consolidation. We're down to the point where we actually get to do the consolidation worksheet, which is exciting. Been waiting for that to happen. So now we've got P's books, we've got S's books here, and we're going to total them up. So standard process, we're going to say, all right, then we're going to total those up. So we total them up here. Then we're going to do our consolidation entries. Now I'm going to start with the first one. This one, I'm actually going to do it the normal way, the way we would normally do it. And then we're going to scroll down here and make the adjustment in accordance with our table. We could just take these numbers from the table first, but I want to just be able to tie this out as much as possible so you can see the steps that are happening as we get more complicated in this thing. All right. So I'm going to add the blue thing here so we can do the reveal process of the journal entry, which will be more exciting. So we have the investment. So here's the investment. We know this one needs to go down to 0. Pretend I didn't put the number there yet. We'll get back to the number later. And then we're going to go to the equity section. So typically we remove basically S's equity section, because that's going to be reflected in the equity method by P in the investment account. So we're going to say then the common stock of the 70,000 has a credit here. We're going to debit it, doing the opposite thing to it. If we just post that as we go, we had P's, we had S, that adds up to the total. We basically removed S, we're back to P's balance here. Then we're going to go, okay, same thing for the retained earnings. It's a credit here of the 62,000. We're going to debit it 62,000, posting that then. Here's P's, here's S, here's the total. Removing S, there is P's remaining. Then we're going to say, all right, let's do the dividends. So dividends, 17,000. That's a debit, so we're going to credit it to make it go down. Dividends for P, dividends for S, total. Then we removed S's, and that brings us back to P. All right, then we're going to go to the income from S. This is where it gets a little bit different here. We're going to say, all right, income from S is down here. Typically, we could say we need to get that to 0, but usually we start off and say, let's just do like the equity thing first and say, let's pull out our portion, the 31,000, times our portion, or 70% of it. Trusty calculator. So that's going to be the 31,000 times 0.7, which is going to be that 21.7. So I'm going to say, all right, we're going to debit this 21.7, which brings it past 0, but that's what we're going to do for now, because that's how we've been thinking about this in the past. Then we're going to have the non-controlling interest. The other side of that 31,000 needs to go to the non-controlling interest right here. So I'm going to say, all right, then we got the 31,000 times 0.3 is going to be going there. So 0.3, so there it is there. And then we're going to have the non-controlling interest in the net assets. So to think about that, let's add up the net assets, assets minus liabilities, green and yellow here. We're going to say, all right, that's going to be 17600 plus 6000 plus 3700. Whoop, did I do that right? I think I missed a 0. 17600 plus 6000 plus 37000 plus 42000 plus 626000 minus 90,000 minus 37,000 minus 90,000 minus 16. That's going to give us the 146. That 146 then is what we're going to split 30. So 30% going here then. So times 30% is going to be the 43.8. Now note, I can get to that same amount that we're going to split by adding up, and I won't do it here, but we could add up all the equity. Equity section would do the same thing. We can do it real quick here. This is going to be 70,000 plus 62,000 minus 17,000, and then I'll just add the net income. So plus, because all this will be part of net income, plus net income of 31,000. We get to that same 146. And then, of course, we've also reflected that basically in the meat here, in the equity section in the middle. So that's going to be the 70,000 plus the 62,000 plus the 21.7 plus the 393 minus the 17,000. So there's the 146. And so I broke out 30% of it here. The other 70% times 0.7 will be up top, the 202 up top. So then if we record this out, then this is going to be our standard type of transaction. We've got the investment. Doesn't go to 0 here, but it is what it is. And for now, so that's good. And then we already saw these items. We saw this item, the non-controlling interest down below here, and the income the non-controlling interest in the net assets are going to be up top. All right, so now let's take this and make some adjustment to it for the worksheet we put together. Okay, so hopefully this will help us see exactly what the change is that we made a little bit more clearly. So we're going to say, all right, so now this is what we did. I've color-coded. This is the journal entry we did, and here's the worksheet we're just basically going to change it by. So now we're just going to take these numbers and change it by the worksheet on the right. So for these 4 items. So for example, if I take this non-controlling interest item here, that non-controlling interest ties out to this non-controlling interest. This is what the original journal entry is. We adjusted it to this 9660. So I'm going to say, all right, well then, if I make that adjustment down here, I'm going to take that same non-controlling interest in NA, non-controlling interest in NA, and just subtract out here. We got the 9300 minus the 9660, and that would be the 360, basically the difference that we need. So then same thing if we took the 21.7, here's the 21.7 that we would have originally used. And then we're going to adjust it to 18,540. So that's going to be the 18,540 that we will adjust it to. So if I subtract that out, that's going to be the 21.7 minus the 18,540, and that's going to be our adjustment that will make a credit to get to that 18,540 of the 3,180. And then here we would have had the 43.8, and now we're going to adjust it. We're on the balance sheet side of things to this, right? So I'm going to say, all right, we're going to make it the 44,160 minus the 43.8. That's going to be the 360 adjustment here. And then finally, we had on the balance sheet side of things, the investment, and we're going to say the 1022. So the 1022 minus what we're going to adjust it to, the 99040, and that's going to be that 3160. So if you combine these two together, then, so in other words, you could take this first journal entry and simply replace these bottom line numbers, and you'll still be in balance. Or we can make another entry to reflect basically what this table is telling us, what we need to do, the 4 numbers that will be adjusted. So you can kind of mull that over both ways and see what it'll look like. So if you were then to make these adjustments, now I'm going to post these items into our problem. We've now adjusted this and just adjusted the investment account, adjusted the income from S here, and the non-controlling interest here, and then the non-controlling interest here. So that's what we have thus far. So then that's going to be like our normal entry. That's like the big one to get the equity lined up. This one's still not at 0 up top. So like this one's still not at 0. This one's still not at 0. So we're not there yet. So I'm going to go back down and say, all right, so this is what we've done thus far. This is the one we're going to be working on at this point. So the one we want at this point, we're going to say the depreciation, expense, and amortization. So we'll record the depreciation and amortization for the added amount, the 22 and the 47, just the depreciation and amortization for the current period. So this is going to be the current period. So I'm going to say, all right, that's going to be the 22,000 divided by 10 years, 2,200. I'm not taking 70% of it. I'm recording the full amount now of the depreciation for the combined items that we will then allocate out between controlling and non-controlling interest, and then the 47,000 times or divided by 5. That's going to be the 9,004. So then if we take that 9,400 plus the 22,000, we're going to allocate that out between the non-controlling and controlling interest on the income statement side of things, which is controlling interest income from S is reflected here, non-controlling interest in non-controlling interest in net income. So we're going to take that times the 0.7. Something funny happened here. Let's do that again. 22,000 or 2,200 plus 9,400 times 0.7. So there's the 8120, and then if we took that 2200 plus the 9400 times 0.3, there's the 3180. Posting this out, of course, increases the expense accounts. Then we allocate portion to the income from S, bringing it to 0. So we've done everything there to bring it to 0. That's good. The other side going to the non-controlling interest account. Okay, next. This is what we have done thus far. Here's the new thing that we're going to be working on. So now we're going to be putting the property, plant, and equipment on the books, right? So we had, once again, this 22 and this 47. So that went on the books. That happened 2 years ago when the sale took place. It was higher by 22 and 47, which we want to reflect in our consolidation. So we're just going to simply debit the machinery, which is going to be the depreciable assets, debit the intangible assets for the 47. And then the other side of that, we're also going to record at this point in time the related depreciation expense and amortization. So it's been 2 years now. So we calculated depreciation for the current year last time up here. So these two were calculated for 1 year, but it's been 2 years. So these are going to be the amortization. So I'm going to take that 22 times 2, and that'll be the 4,400 for the accumulated depreciation. And then for the amortization, we don't have an account called, we don't have one intangible amortization. We just simply are going to write down the intangible asset. So notice I put the intangible asset on the same thing twice instead of netting out that amount so that we can see, both sides of this. So the other side of this is going to be the amortization, which is the 9,400 times 2, and that's going to be that 18,800. Okay, so then if we took this whole thing, this plus this, minus we would break it out based on the balance sheet accounts for the parent and subsidiary breakout, the controlling, non-controlling interest, meaning the investment account up here, and then the non-controlling interest in NA here. So let's do that. We're going to say, all right, and then 22,000 plus 47,000 minus 4,400 minus 1,8800 times 0.7, there's the 3260. And then if I took the 22,000 plus 47,000 minus 4400 minus 18800 times 0.3, there's the 740. So the machinery and tangible assets are affected. So that's included here, machinery and intangible assets. Then the accumulated depreciation is affected. Then the intangible assets have been going up and then back down as well. So that's going to the same account. And then the investment account is going to be up top. So investment account was affected up top. We still have 14,000 we need to deal with. Non-controlling interest on basically the balance sheet side, net assets affected as well. Okay, scrolling down, this is what we have thus far. These are the journal entries we've done thus far. Here's the current one we are working on. This one isn't a new one. We said the accumulated depreciation of S at purchase was 50,000. So we're going to say at the time of purchase, if we looked at S's books 2 years ago at the time of purchase, this accumulated depreciation was 50,000. We want to net that out into basically the fixed asset account as if it was like a purchase that took place. So we've seen this in the past. I won't spend a lot of time on it. We're going to debit the accumulated depreciation and credit machinery, which is the depreciable asset. So that's going to be this account affected and this account affected. So similar that what we've seen in the past. And then so if I scroll down, this is what we have thus far. This is what we've done thus far. This is the new thing we're doing. So now we've got to deal with basically the cost of goods sold. We got to deal with the transactions that happened in the current year. Mainly you kind of thinking about the cost of goods sold and then the revenue for the transactions that were basically the intercompany transactions. So first we're going to go to this item. We're going to say we're going to credit the cost of goods sold. We're going to get this information from our worksheet once again. So here's our worksheet that deals with these intercompany transfers. So we're going to pick up this 11,600, and that's the amount that we're going to be crediting. Then we're going to allocate that cost of goods sold between the investment in S and the non-controlling interest. In other words, the balance sheet kind of accounts controlling non-controlling interest. So notice I started with cost of goods sold even though it's a credit, because that's the first thing I would think about, right? I would think about this item is going to be reflected in the cost of goods sold up top and then break it out with our 70-20 split. So we're going to say, and actually I shouldn't say 70-20 split. It happens to be a 70-20 split this time, but I don't want to think about it that way, because if there was something up top here, then you're going to be taking it from this table. And in other words, this one, the gross profit deferral down, this total amount would only be allocated to P, and therefore we'd have a different amount here. So you want to be picking up, not really getting the habit of taking a 70-20 split, even though it will be the case this time. You want to take it from the table, which would be this amount, 8,120, and then this amount, this 3,480. And so that'll be that one. So cost of goods sold then affected, investment account affected up top here, and then the non-controlling interest affected here. All right, next one. Scrolling down, this is what we've done thus far, and this is the one that we're going to be concentrating in on now. And this one's kind of like the new one. It's kind of the funny one, because we need to account for the fact that we had this. We're taking this data for the upstream transaction that happened in 2000X2, and then not all of it was sold in 2000X3. Part of it was sold in 2000X3. So we have this sale, this intercompany sale that happened in 2000X2, and then the inventory resulting from it still being on the books in 2000X3, that 8,400. So what we're going to do is we're going to take this 8,400, we're going to credit inventory for it, and so we're going to credit the inventory, and then the other side we're going to be breaking out based on our 70-20. So I'm going to break this out and say, all right, there's that 8,4 times 0.7, and that's going to be the 5,880, and then the 8,400. Not 70-30 split times, let's do that one more time. Starting to get a little tired here. 8,400 times 0.7, there's that, and then of course the 8,400 times 0.3. Okay, so there's our breakout there. That would be affecting then the inventory up top, and then the investment account here, and then the non-controlling interest account. All right, and then finally, we're going to go back down. This is what we have thus far, and this is going to be our transaction. Now we're going to reverse the revenue. Now, when you think about the revenue, it's fairly straightforward because you're reversing the current year revenue. You got to reverse the current year revenue transaction. So if we take our data again, we're looking for the X3 current year, sales 32,000, and then this happened in the prior year, so not that one. This one, the upstream transaction, the 90,000. So I'm going to pick up those two, the 90 and the 32 for the 122. And then the next thing I would think about is the inventory, because that you can pull from basically our table that we put together here. So the non-controlling, so here's our table we put together, non-controlling interest and P, and we already accounted for this 11.6. Now we're looking at basically the current year items here. So we're going to be picking up the 4,000 and the 10,004. The 4,000 and the 10,004 adding up to that 14,004. That's going to be a credit to the inventory, and then you can basically back into the 107.6 cost of goods sold, 122 minus the 14.4, 107.6. So that's going to be decreasing then the revenue, and then the inventory up top is going to be recorded up top. For the inventory is going to be adjusted, and then the cost of goods sold is going to have an adjustment as well. And so here's our ending numbers. So these are back down to 0. So that's a nice check to have. We have the P equity section is basically the P equity section here. Also nice check.